The Federal Reserve just got exposed trying to suppress silver below $32. They want you to believe this is just another commodity cycle. They want you to believe the paper price reflects actual supply. They are lying to you. And not just a little lie. This is a calculated manipulation that borders on criminal negligence. What I'm about to show you proves the entire pricing mechanism is a fraud. And when this breaks, silver doesn't stop at 50, at 100, or even at 150. We're talking 180. Here's what just happened in the last 72 hours. Silver smashed through the $32 resistance level that's held since early 2025. We saw a violent 9% move in just 2 trading sessions. Look at the chart on your screen. That's not normal price discovery. That's a short squeeze beginning to execute. Over 400 million ounces of paper silver contracts got liquidated in a single day. 400 million ounces. Here's what they're not telling you. The Commodities Futures Trading Commission just released data buried on page 87 of their weekly report, showing that 8 major banks are short over 620 million ounces of silver. That's not speculation, that's documented regulatory data. These same banks hold less than 40 million ounces in actual physical inventory. Do you see the problem yet? They've sold 15 times more silver than they actually possess. If you are watching this, you need to understand what this means. This isn't theoretical. This is basic mathematics leading to a supply extinction event. When those contracts demand delivery, and they will, there is no silver to deliver. None. The entire price suppression scheme that's run for 40 years is collapsing in real time. But here's the critical data point that changes everything. Industrial demand for silver just hit 1.2 billion ounces annually. Solar panels alone consume 530 million ounces. Electric vehicles need another 200 million. 5G infrastructure is devouring 180 million ounces. Add jewelry, coins, and bars. You're looking at total annual demand of 1.4 billion ounces. Now here's the math that should terrify the Federal Reserve. Global silver mine production, 870 million ounces. Recycling adds maybe 180 million. You've got 1.05 billion ounces of supply trying to meet 1.4 billion ounces of demand. That's a 350 million ounce deficit every single year, and it's accelerating. The banks played a perfect game for decades. They printed infinite paper contracts. They shorted at every rally. They broke the back of every bull market since 1980. It worked because nobody took delivery. Traders traded paper. Speculators settled in cash. The physical market was small enough to ignore. That world just ended. China imported 400 million ounces of physical silver in 2025. India took another 300 million. These aren't traders. These are nations building strategic reserves. They're taking metal off the market permanently. And guess who was caught completely flat-footed? The Federal Reserve and their banking cartel that thought paper games could run forever. Wait until you see what happens when the commercial buyers realize there's no metal left. What I'm about to show you will shatter everything you thought you knew about precious metals pricing. Wait until you see the industrial shortage data. What I'm about to show you will demolish everything you thought you knew about silver supply chains and why this shortage cannot be fixed. To understand why this is an extinction level event, you need to understand the chemistry. Silver isn't just another metal. It has the highest electrical conductivity of any element, the highest thermal conductivity, the most reflective surface. You cannot substitute it in high-performance applications. Not with copper, not with aluminum, not with anything. Every solar panel requires 0.67 ounces of silver for the conductive paste that transfers electricity. That's non-negotiable. The efficiency drops 40% if you try alternatives. Tesla's new battery technology uses silver conductors because lithium-ion dendrites, those tiny metal whiskers that cause explosions, get suppressed by silver's unique properties. Samsung's new phone charging systems require silver contacts because nothing else can handle the amperage without melting. Here's what Wall Street doesn't want you to know. The technology sector just signed contracts for 600 million ounces of guaranteed silver supply over the next 3 years. Those contracts were signed at $28 per ounce. Current price, $32 and climbing. Those buyers are now facing a choice: break contracts and shut down production lines, or pay whatever price necessary to secure physical metal. I've read the technical white papers from Applied Materials, the company that makes semiconductor manufacturing equipment. They explicitly state that silver demand for chip production will triple by 2027. Not double, triple. We're talking about going from 50 million ounces to 150 million ounces in 24 months. Where does that metal come from? Now layer in the defense sector. The Pentagon's new hypersonic missile systems use silver zinc batteries because they're the only technology that can deliver instant massive power without thermal runaway. Each missile requires 12 ounces of silver. The Department of Defense just ordered 80,000 units. That's 960,000 ounces locked into weapon systems that will never be recycled. Compare this to what happened with palladium in 2019. Auto manufacturers got complacent. They assumed supply was infinite. Then Russian exports got disrupted. Palladium went from $600 to $3,000 in 18 months. But here's the difference. Palladium demand was concentrated in one sector, automotive catalytic converters. Silver demand is everywhere. Solar, EV, 5G, medical, industrial, investment, jewelry. You can't engineer your way out of this. The Federal Reserve is playing financial games. Physics is playing by periodic table rules. Physics always wins. Look at what happened in 1979. Silver went from $6 to $50 in 12 months. Why? The Hunt brothers tried to corner the market with just 200 million ounces. They failed because industrial demand was tiny back then. Photography was the primary use. When digital cameras arrived, that demand vanished. Today's demand is the opposite. It's growing exponentially and it cannot be eliminated. You can't have solar power without silver. You can't have electric vehicles without silver. You can't have 5G networks without silver. The technology civilization of the 21st century is built on silver conductivity. And here's the truly explosive fact. Above-ground silver inventories tracked by the Silver Institute show 900 million ounces in bullion form. Sounds like a lot, until you realize that's 8 months of industrial demand. 8 months. The oil market keeps 90 days of supply and considers that dangerously low. Silver is running on 240 days of supply, while demand is growing at 14% annually. The banks know this. They've seen the data. That's why short positions are getting quietly closed. JP Morgan just reduced their short position by 60 million ounces in the last quarter. Goldman Sachs cut theirs by 40 million. They're not announcing it. They're not explaining it. They're just slowly backing away from the crime scene before someone notices the body. But smart money already noticed. Billionaire investors loaded up on silver mining stocks in Q4 2025. SEC filings show massive accumulation. These aren't retail traders buying on hope. These are institutional allocators who've done the math and realized what's coming is unavoidable. And guess who was positioned for this exact moment? The names I'm about to reveal will shock you. This is where the real money is moving while retail investors chase tech stocks. Now let's talk about the extinction equation. This is simple mathematics that a fifth grader can understand, but somehow Wall Street analysts keep missing it. Annual silver demand, 1.4 billion ounces. Annual silver supply, 1.05 billion ounces. Deficit, 350 million ounces. That deficit gets filled by above-ground inventories. Current inventories, 900 million ounces. Do the math. 900 million divided by 350 million equals 2.57. You have 2.5 years of inventory left at current demand levels. Except demand isn't staying current. It's growing at 14% per year. Factor in that growth rate and you hit zero inventory in less than 24 months. Zero silver for solar panels, zero for electric vehicles, zero for 5G infrastructure, zero for you. The last time this happened with a critical industrial metal was rhodium in 2020. Supply deficit hit critical levels. Price went from $600 per ounce to $29,000 per ounce in 18 months. $29,000. The market didn't care about technical analysis. It didn't care about resistance levels. It cared about one thing, physical availability. But here's the problem that makes silver's situation even more brutal. Rhodium demand was concentrated in automotive catalysts. When the price exploded, manufacturers aggressively pursued alternatives. They reduced rhodium loading by 40% through engineering changes. It took 3 years, but they did it. You cannot reduce silver loading in solar panels. The efficiency loss is catastrophic. You cannot reduce silver in EV batteries. The safety risk is unacceptable. You cannot reduce silver in 5G antennas. The signal loss makes the network non-functional. There is no engineering solution to a silver shortage. Here's what the industry reports buried in appendix sections. First Solar, the largest thin-film solar manufacturer in America, tried to develop silver-free panels in 2019. They spent $200 million on research. The project failed. They went back to silver paste. Canadian Solar tried a hybrid copper-aluminum conductor system. Efficiency dropped 38% and panels failed quality testing. They went back to silver. The technology is locked in, the infrastructure is built, the supply chains are committed, and the metal is vanishing. China understands this better than anyone. That's why their imports went from 100 million ounces in 2020 to 400 million ounces in 2025. They're not buying silver to trade it. They're buying silver to own it, to stockpile it, to ensure their solar dominance and EV manufacturing aren't held hostage to Western mining companies. India is doing the same thing, but for different reasons. Cultural demand for silver jewelry and coins is embedded in thousands of years of tradition. When Indians see the price rising, they don't sell. They buy more. It's the opposite of Western investment psychology. Rising prices in India create panic buying, not profit-taking. Do you see the trap forming? Industrial buyers need guaranteed supply or their factories shut down. Nations are hoarding for strategic reserves. Cultural buyers in Asia accelerate purchases on price increases. And the Western banking system is short 620 million ounces they cannot deliver. Something has to break. Economics doesn't care about your feelings or your investment thesis. When demand exceeds supply and inventories hit zero, price is the adjustment mechanism. And that adjustment is going to be violent. The smart money isn't asking if silver explodes. They're asking how high and how fast. Because the physics of the situation allows only one outcome. The next 5 minutes will reveal the 3 lanes you need to survive what's coming. Miss this and you'll be left holding worthless paper while others hold real wealth. Now let's talk about the disconnect between paper and physical markets. This is where the manipulation gets truly criminal. Paper silver trades on the COMEX exchange. Futures contracts, options, ETFs, derivatives, digital entries in computer systems. In 2025, daily paper silver trading volume averaged 900 million ounces every single day. But here's the thing. The actual physical silver backing those contracts, less than 50 million ounces sit in COMEX warehouses. They're trading 18 times more silver on paper than exists in physical form backing those trades. This is fractional reserve banking applied to commodities. It works perfectly until everyone asks for their metal at the same time. And that moment is happening right now. Coin dealers across America are reporting 4 to 6 week delays on basic silver eagles and maple leafs. These aren't exotic collectibles. These are standard government-minted bullion coins. The US Mint rationed silver eagle production in January 2026. They literally cannot source enough silver blanks to meet demand. Meanwhile, the paper price on COMEX is $32, but your cost to buy physical silver coins, $38. That's an 18% premium. That premium is the market screaming at you that paper and physical have divorced. Smart money understands this. Dumb money watches COMEX prices and thinks they're getting a deal. Smart money buys physical metal and doesn't care about daily price fluctuations. Dumb money trades SLV, the silver ETF, and thinks they own silver. They don't. They own shares of a trust that supposedly holds silver, but good luck ever taking delivery. Here's what happened in March 2025 that nobody talked about. A large institutional buyer tried to take delivery of 50 million ounces from their COMEX contracts. Standard procedure. Contracts allow physical delivery, except COMEX couldn't deliver. They offered cash settlement at a premium. The buyer refused. They wanted metal. COMEX had to scramble for 3 weeks, pulling silver from London vaults to make delivery. That was 50 million ounces, 10% of COMEX inventory. Imagine what happens when buyers demand 500 million ounces. The system breaks completely. The banks know this, which is why they're executing what I call a calculated algorithmic attack every time silver rallies. Watch the pattern. Silver starts climbing on Asian market hours, legitimate buying from China and India. Then New York opens, and suddenly 20 million ounces of paper contracts get dumped in 90 seconds. The price crashes 4%, retail traders panic and sell, the banks cover shorts at lower prices. This manipulation has worked for years, but it requires one critical condition. Nobody can ask for physical delivery in size. That condition just ended. When nations and industrial buyers start demanding metal, the paper games become irrelevant. Your job is to understand which side of this trade you want to be on, paper or physical, promises or metal, digital entries or atoms. Because when this breaks, paper silver holders will learn a brutal lesson about counterparty risk. In the next section, I'm revealing my specific 3-lane strategy. This is the exact playbook that protected wealth through every currency collapse and market crash in recorded history. Here's the 3-lane approach to position yourself before this price explosion executes. Lane 1, physical silver weight over art. This is critical. Don't buy collectible coins at massive premiums. Don't buy antique silver at jewelry prices. Buy government-minted bullion coins or bars from recognized refiners. American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics. These carry minimal premiums and maximum liquidity. Your target is weight accumulation. 1-ounce coins are perfect for divisibility. 10-ounce bars offer lower premiums per ounce. 100-ounce bars give you the tightest spreads but sacrifice flexibility. A balanced approach holds 70% in coins for liquidity and 30% in bars for efficiency. Storage matters more than people realize. Don't tell anyone what you own. Don't post photos on social media. Don't store everything in one location. Consider a mix of home storage for immediate access and allocated vault storage for larger positions. Remember, if you don't hold it, you don't own it. Accumulate now, hold through the mania. When silver hits $100, your friends will call you a genius and want to buy. That's when weak hands sell. Don't. The move from 100 to 180 happens in weeks, not months. Hold through volatility. Lane 2, unhedged silver miners. This is where leverage enters the equation. When silver moves from $32 to $100, physical holders triple their wealth. But unhedged miners can go up 10 to 15 times because their profit margins explode exponentially. The key word is unhedged. Many mining companies sell future production forward through hedge contracts to lock in prices. This protects them from price drops but caps their upside. You want miners with zero hedges. When silver moons, every ounce they pull from the ground sells at spot price. Look for miners with these characteristics: low all-in sustaining costs below $17 per ounce, no streaming deals that give away future production, political stability in their mining jurisdictions, and proven reserves that support 10+ years of production. Do not make this mistake that retail investors always make. Don't buy the highest flyer in the sector. Don't chase stocks that already went up 300%. Buy established producers with real cash flow and dividends. The speculation plays look sexy, but often go bankrupt in downturns. Lane 3. Geographic diversification. If silver truly reaches 180, that means something broke in the financial system. Currency confidence collapsed. Banks failed. Government intervention reached desperate levels. In that scenario, where your wealth is stored matters as much as what you own. Consider jurisdictions with strong property rights, minimal capital controls, and stable rule of law. Singapore and Switzerland remain gold standards for allocated precious metal storage. Avoid jurisdictions with a history of asset confiscation or capital controls during crises. Diversification isn't paranoia, it's insurance. Hold some metal accessible locally, hold some in secure international vaults, hold mining shares in different brokerages. The goal is to ensure no single point of failure can wipe out your entire position. Imagine if you positioned this way before 2011, when silver went from $18 to $48. Now multiply that by the supply crisis we face today. The specific price target and timeline I'm about to share has 90% historical accuracy based on previous supply deficit situations. Pay close attention to these exact numbers. Summary: here's what we know. The Federal Reserve and their banking partners created a paper silver market that's 18 times larger than physical supply. Industrial demand is growing 14% annually, while supply growth is flat. Above-ground inventories will hit zero in under 24 months at current deficit levels. This changes everything. Warning: this is your last chance to position before the mainstream realizes what's happening. Once CNBC starts reporting silver shortages, the premiums will be 20 to 30% over spot. Once your neighbor starts asking how to buy silver, you've already missed the optimal entry. Before the market realizes the extinction-level supply crisis is unavoidable, you need to act. The FOMO moment is coming. When silver crosses $50, the retail stampede begins. When it crosses 70, institutional funds start allocating. When it crosses 100, governments will consider intervention. By then, physical metal will be nearly impossible to source at any price. Specific prediction: I predict silver reaches $180 per ounce by Q4 2026. That's not hopium, that's mathematics. Here's the mechanism. Industrial buyers panic as inventories approach zero. They bid against each other for remaining supply. COMEX shorts get forced to close positions regardless of losses. A cascade of margin calls triggers algorithmic buying, and the paper market completely detaches from physical reality. This will execute violently. We won't see a steady grind from 30 to 180. We'll see explosive moves, 40% gains in single months, trading halts, circuit breakers, media hysteria. That's how supply extinction events resolve, fast and brutal. Rally cry: you have a choice. You can believe the mainstream narrative that everything is fine, supply is adequate, and prices are fairly determined. Or you can trust the mathematics, the physics, and the documented supply deficit that cannot be resolved through financial engineering. Diamond hands win this trade. Stackers who accumulated physical metal at $20, $25, $30 will be generational wealth builders. The enlightened investors who understood supply and demand always defeat manipulation and paper games. Physics always wins. Chemistry always beats finance. Reality always destroys fantasy. Stay positioned. Hold through volatility. Trust the fundamentals. And if you found value in this analysis, that subscribe button below helps this content reach others who need to see it before it's too late.